Welcome to our discussion on understanding interest. Today we're going to look at how to calculate simple interest, what it means to have a future value, how to calculate compound interest, and how to calculate annual percentage yield, which basically just means the actual interest you're paying. So what is interest? Well, it's the amount charged by a lender for borrowing money, or it can be the amount of money you earn on an investment, right? If you have like a savings plan, you can actually earn that interest rather than owe the interest. The principal is how much money you initially borrow, and then the interest, on your loan is charged on that, or it's the initial amount of money that you put into your savings plan that is going to earn interest, right? So it's always just the initial lump of money that the interest is calculated on. And the interest rate is the amount charged or given to you, right? And it's always expressed as a percentage. So your APR, your annual percentage rate, is the yearly interest rate that is charged to you for borrowing money, or it's, again, if you're saving, it's the same thing. Now, APR is normally given as a percentage per year, even if your interest is calculated monthly or daily or whatever it is. They're going to tell you what the APR is for the year. A simple interest formula, well, simple interest really doesn't exist in the real world. We just use it as a teaching tool. Everything is compound interest. You're never going to pay simple interest on anything. But simple interest, I for capital is, for interest, it equals PRT, principal times rate times time. And time is usually calculated in years. So here's a simple example. If you want to determine the interest that is accrued, i.e. owed, on $5,500, if you have it for 5 years at a rate of 8.5%, you simply plug everything in that you know. You know the principal, the amount borrowed was $5,500. That goes in for P. You know the interest rate is 8.5. You write that as a decimal, 0.085. And you know the amount of time, 5 years. So you put a 5 in there. You multiply those all together. And you would owe $2,337.50 at the end of those 5 years, in addition to, of course, the $5,500. So the total amount owed would be the $78,37.50. Now, again, they don't normally do simple interest, but you can see that even at just 8.5% simple interest in 5 years, it's more than half of what you borrowed, right? You're basically paying back 50% extra. So interest can really add up a lot. Ian's purchasing a new television with a deal from the Big Screen R Us, and the deal offers 90 days, same as cash, to make the purchase. This means that at the end of 90 days, if Ian has paid off the cost of the television, he owes no interest charge. However, if you do not pay off the amount, you owe simple interest for the original purchase amount calculated over the entire 90 days. So basically, they are charging you interest for the first 90 days. As long as you pay it off in full, you don't owe it. But if you don't, you get hit with it, right? It's pretty typical kind of, you almost want to say scam that a lot of places that sell you things will run. So if the television costs $26.50, tax included, so we're figuring that's the amount, you pay total, with an annual interest rate of 21.99%. That is horrendously high, right? That's terrible. How much would he owe on the 91st day if he made no payments during the first 90 days? Well, we want to determine the entire amount due after the 90 days has expired, assuming that you haven't paid anything. So this means that all $26.50 is still due in addition to the amount of interest over the 3 months that they borrowed the money. Well, remember, these formulas, time is always in years. So 3 months, 3 out of 12, is 1/4 of a year. So now into the formula, we put 1/4 for time. We put 0.2199, because that's the 21.99% as a decimal. We put in the $26.50 as the principal. And at the end of those 3 months, if you don't pay off the full amount of $26.50, you're going to owe an additional $145.68. So when you add that back, you can see that now all of a sudden that TV costs $2,795.68. So again, interest adds up. So we can find the total cost of a loan for $43.20 that has simple interest of 15% for 18 months. You plug everything in, and you get 52.92. Compound interest. Now, this is the one that actually exists in the real world, where the future value of the money we call A for amount, P is still principal, T is still time in years, R is still interest rate as a percentage, but now we have N for number of compounds per year. So here's the simple formula. I know you're thinking, what's so simple about that? It's actually pretty simple. It's not too difficult. Again, P is your principal, R is your interest rate, always written as a decimal. N is the number of times the money is compounded per year. So the amount of times the interest is compounded in a 1 year period. And then T is time in years. So if we're getting compound interest that is compounded annually, our N is 1 because it's only being compounded once per year. Semi-annually means twice per year. Quarterly means 4 times per year. Monthly is 12. Weekly is 52. And daily is 365. Let's look at an example. Lily deposits $12,000 into an account with an annual interest rate of 4.5% compounded monthly. So now we know N is 12. She leaves the money in the account for 10 years. So now we know T is 10. We know that P is 12,000. We put all those bits and pieces into the formula, right? So here's our 4.5% as a decimal. Here's our 12. Even though she goes for 10 years, we don't put 120 here. It's still, N is always the number of compounds in 1 year. Doesn't matter how long you're compounding it for, N is always how many times it would be compounded in just 1 year. So since it's compounded monthly, N is 12. Up here is where we take into account how long it happens, and that's where we get N times T, and you see that we get a total of 120 compounds, right? If it's compounded every month for 10 years, it ends up getting compounded 120 times. So that's what NT really gives us, is the total number of compounds. You do the math, right? 0.045, you divide that by 12, you add that to 1, you get 1.003 if you rounded. And then you multiply that, you raise that to 120, you multiply it by 12,000, and at the end of 10 years, she would have roughly $18,800 and almost $804 in the account. So she basically made $6,800 in interest. So remember, interest is powerful. It can be powerful when you owe money, but it can also be powerful when you're saving money. So let's try this. See if you can use the information from the previous example and find the future value of Liz's account after 20 years. So what are you going to change for 20 years, right? There's only one thing you're going to change. All right, pause it, see if you can get the right answer. Did you get 29,465? Did you see how much bigger it got in another 10 years? Right? We went from 18.8 to 29.4. That's huge, right? That's how interest works. It grows faster and faster and faster the longer you let it go. Here's another example. So Thomas uses $4,500 to open an IRA, which is short for an individual retirement account. It's just basically a long-term savings account, if you want to think of it that way. It earns 3.8% APR. If he leaves the money alone, what is the future value after 8 years for the following different compounding intervals? So let's look at what happens when it's compounded yearly, quarterly, and weekly. Which one do you think is going to give you more money, right? If you compound it more frequently, do you think you're going to get more money? Well, you'd be right if you said yes. So here it is yearly, right? Nothing changes. $4,500 for the principal, 0.038 because that's 3.8%. The time is 8 for 8 years. But now it's compounded yearly, so N equals 1. We throw that in the formula, a little over 6,000. Now, when it's compounded quarterly, that's 4 times per year. Put that in there. It's a little bit more. Not a lot, right? 6,064, 6,089. So not a huge difference. Then we do it weekly. Again, not a huge difference. Just goes up to 6,098. The main reason why it's not a huge difference is it's only 8 years. And I know you're thinking, wow, 8 years is an eternity. But it really isn't in the grand scheme of things when we're talking about compounding interest. If we did this for longer, you'd see much bigger differences between the two. So hopefully you notice that the more compounding intervals that occur in a given year, the larger the amount of money you get. So basically, the more often something is compounded, the more interest will accrue at the end of whatever time period you're looking at. Which brings us to what's called continuous compounding. So this is what is normally used in the real world. So even if you have a loan and you have to make monthly payments on the loan, your interest is not calculated monthly. Your interest is calculated continuously. You're just charged monthly. So most things in the real world are computed with continuous compounding, and it does make a difference. Again, not a huge difference if the amount is small or the time is small, but once you get a bigger amount, a larger amount of time, or a larger interest rate, then it makes a huge difference. So we can find the future value of $8,900 invested at a rate of 2.05%, compounded continuously over 15 years. So P is our principal, 8,900. T is our time of 15. R is our interest rate as a decimal. And then E is a special button on your calculator. It's the exponential button. It's an actual number. E is 2.7 something, something, something. It's like pi. It's one of those irrational numbers that goes on and on forever and never repeats. So you have to use, a special tool, either a special calculator or, Excel or Google Sheets or something to be able to calculate these. But in any case, after 15 years at 2%, you would see that 8,900 grows to 12,000, which is, that's a pretty big difference, again, because of the time. So assume you wish to deposit 2,500 into an account that gives you 6% interest for 10 years. What is the maximum future value possible after 10 years? And what is the maximum amount of interest possible after 10 years? Well, we know that the maximum amount is always going to be with continuous compounding. So we would do continuous compounding with our 2,500, our 6%, our 10 years. And we would see that the maximum amount we would have would be 4,555.3. If we subtract the initial deposit of 2,500 from it, then we see that the maximum interest earned would be 2,055.30. So continuous compounding is always the maximum, right? It's the most interest you can earn is continuous. You can't do anything more frequently than continuously. Okay, APY, annual percent yield. This is called the effective interest rate. And what it means is it's what you're actually paying in reality if you were to just think of it as a one-time compounding, right? So the idea is, sure, your interest is being compounded monthly, or sure, it's being compounded continuously. But at the end of 1 year, what does that mean as far as how much has something gone up as a percentage, right? What is that percent increase at the end of 1 year? And it's always going to be more than what the APR was, the percentage rate. And here's the formula for it. You just plug in your rate, you plug in the number of compounds, right? And you do this. Now, this obviously only works for compounding that happens other than continuously. And this is fine. It's a fine formula. It works fine. And you're going to have a different formula for when it's continuously compounded. I'm going to run through these because, it's what the book's going to show you. But I'm going to show you a better way of doing this that works for all compounding, whether it's continuous or not. So you don't have to memorize multiple formulas. All right, so let's run through these kind of quick, and then I'll show you the better way. So here's 5,000, 5%, right? Compounded monthly, and then find the APY. So we plug all this junk in, and we get that, see, 5% monthly means that at the end of a year, it's actually gone up by 5.116%. So that's what the APY would be. It says, that's how much it grows every year. If you do it daily, then you can see that it goes up, and now it goes up by 5.127% in a year. Again, we're still doing 5%. It's just getting compounded more frequently. So as you can see, it's more than 5%, which is why, by law, lending institutions have to tell you what the APY is, right? They'll tell you what the APR is, but then in small print, somewhere usually on the back of something, it will tell you what the actual APY is as well. So to find the APY for each loan category, we need to, do the same formula for all of them, blah, 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 right? And figure out all of them, and then there's the APYs for all of them. Now, how do we do this for continuous compounding, right? This formula doesn't work for continuous compounding. We would have to make some adjustments. So here's what you do. No matter what the situation is, whether they're asking you to figure out APY for something that's compounded, monthly, daily, yearly, or continuously, all you have to do is deposit $100 for 1 year. That's one year, using the APR and compounding. So for instance, if they say, one of our previous examples, which was 5% monthly, all right, then we use our monthly, our monthly formula. So we know that A equals P times 1 plus R over N to the NT. That's our formula. We plug in everything we have. So 100, remember, for our principal is always going to be 100. 1 plus our interest rate, our compounding of monthly, which is 12. And then we do it for 1 year, so T is always 1. So we just simply raise this to 12. You plug that into your calculator, and you get a number. And if you want to try it yourself, the number you should get is 105.1161898. Okay, so now, because we used 100, it makes our life really easy, because all we do is look at how much extra money we make. Right? Ignore the 100 and just look at how much interest we made. We made $5 and blah, 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 blah. Well, that's our percentage. Our APY is 5 point blah, 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 blah percent. It's that simple. And if we go back and look at the solution they gave us for 5%, there it is, 5.116% when it was monthly. See how cool and easy that is? So, what if we had to do it for continuous compounding? Well, the formula for continuous compounding, you'll remember, is, I always remembered it as A PERT, right? A equals PERT. So 100 E to the 0.05, because remember T is 1. Plug this into your calculator, and you get 105.1271096. You round to, however many decimal places they want you to round, because that right there is your APY percent increase for continuous compounding now at 5%. So it's a beautiful, simple little trick. If you just use $100, it makes the math really easy, because all you're doing is calculating how much actual interest you would earn in 1 year, which is what APY is. And then we always want to figure out it's what percentage of where we started. Well, if we start with 100, then whatever we have is an automatic percentage, right? $10 is 10% of 100. $5 is 5% of 100. So by starting with 100 and doing it for 1 year, we can calculate our percentage, and we don't have to memorize a new formula. We already know the formula for compound interest. We already know the formula for continuous compound interest, and we can use those to calculate APY the better way. Okay, the last example is calculating interest on what are called payday loans. Assume you wish to borrow $300 for 2 weeks in the form of a payday loan, and the amount of interest you must pay is $25 per $100 borrowed. This means that at the end of 2 weeks, you owe $375. What is the APR? Okay, well, remember that APR is the interest rate over a year, and since the loan was for 2 weeks, we need to convert this into a yearly rate. So we can find the APR by using our normal formula of APR equals the short-term interest rate times 52 weeks over the length of the loan. So where the short-term rate is 25%, there's our 25% for 2 weeks. So we do 52 weeks divided by 2 weeks, because that's basically what fraction of a year we paid for it. And you can see that you're actually paying 650% interest. So the moral of the story is payday loans are terrible. Don't ever do a payday loan. You have to be very, very desperate to do that. Go borrow money from from a friend or a relative or something. Payday loans are a scam. All right, that's it.